Hello, everybody. This is Bob Repass, Managing Director of Colonial Funding Group and Note School, as well as the host of the Note Industry Event of the Year, Note Expo. So we are here on May 1st, 2020, and I've invited some industry experts to join me today to talk about the impact of COVID-19 on the note investing space. So I'd like to go around first of all and have my guests introduce themselves, and we'll start with Chaz. Chaz, how are you today?
Doing well, Bob. Thanks for having me. I'm Chaz Gwynn, Managing Director of Revolve Capital Group. We're based in Orange County, California. We've been in this space now for a long time, really since the '08 crisis, and been able to kind of ride the wave since then. Our management team has been together, and we focused on a first lien, non-performing and reperforming mortgage backed by a lower valued home. And lower valued home could be categorized by a $200,000 mortgage value or home value and less. And that's a strategy that we've been focusing on since that time frame. And we allow many of you to be able to get into the space because of that lower band class.
Very good. Next up is Cody Fowler.
Well, good afternoon. Cody Fowler. Fowler Financial is the firm. On the advisory side, we've done loan advisory for about 10 years, and then Buffalo Park is our principal acquisition side, and been buying first lien, second lien, performing, reperforming primarily, but we're also pretty heavy in the non-performing second lien space. And I'm in Tucson, Arizona, and happy to be here to share some information and exchange some ideas.
Awesome, and we're glad you're here, Cody, and I'm glad you told everybody you're in Tucson. Chaz, you're in Southern California today, aren't you?
In Southern California, it's been rainy most of this year, which is not a thing for SoCal. But now the sun has started to finally show out. But it's funny because I always try and get all three of you on this panel, and four of you with David Folio, always to come out to Orange County. How do I pull you guys more and more to this part of this country, especially when it's a little bit colder, where Paul's at and where David's at and things of that nature?
If I went to California, I'd never leave.
Well, I just want to show everybody the diverse panel that we have today, because we are located all over the country. I'm in Dallas, Texas, as most of you guys probably know, and joining us now is David Folio. David's we've not signed the agreement to show his face, so we just have him by phone today. So David, welcome.
Hey Bob, I appreciate your time. David Folio from SN Servicing Corp, also part of SN Trading LLC. We've been around since 1987, acquiring portfolios throughout the country. Servicing portfolios throughout the country, and also working a trading desk that puts out for sale assets from our clients that we service for on our trading desk. My office is in Amherst, New Hampshire. We have two main offices in Eureka, California, and Baton Rouge, Louisiana. So again, I appreciate you allowing us this opportunity, Bob.
And we appreciate you being on there. And last up is Paul Burkett. Paul, how's it going?
Very well, thank you very much, Bob. Thanks for having me on. And greetings from absolutely abandoned New York City. It's funny, I come to work every day because social distancing is just the way we're set up here. It's just as easy to come to work, but it's so weird that I can walk. It's about a mile, maybe a mile and a half from my house to work. And I could almost walk with my eyes closed because there's no one to walk into and no traffic to hit you. It's so weird. The thing I really noticed this morning, I was actually talking to my dad as I walked to work, and he asked me what was the squeaking in the background. And I couldn't understand what he meant by squeaking, but what he was hearing was actually birds chirping. And because there's no traffic, you can actually hear the birds. It's a pretty busy city with all the wildlife. So New York is a very strange place to be right now. But we're a non-performing loan fund. We have about $250 million of assets under management, although I hope I'll hear that a bid was approved today. So that will actually increase us to about $300 million. Two sides to the business. One side is separately managed accounts. So we manage pools of loans for institutional investors. And about half the business is our own assets that we have bought, either with our own money or through our crowdfunding Regulation A placement, where we raise money directly from members of the public over the internet and pool that money to buy loans and buy the loans and work them out. So normally there's 26 of us, but for the last 6 weeks, there's been just me.
Wow. I spent a lot of time in New York City, and I can't imagine nobody on the sidewalks and no cars on the road. It must be an eerie kind of feeling.
So strange.
Awesome. Well, as I mentioned at the top, I'm the host of Note Expo, and we are still planning on having Note Expo the first weekend in November. So it'll be November 6th and 7th in Dallas, and that's 6 months away, so anything can change. But all these guys have been at Note Expo in the past. They've been featured speakers. They've been on panels. And I had the idea earlier this week that we're always hearing, things on Facebook or on LinkedIn and other social media about what people think about what's going on in the market right now. And I thought I'd get folks that I consider experts in the industry to share their thoughts. So first of all, Chaz, how has the stay-at-home shelter-in-place policy kind of impacted you and your company personally or professionally?
I think professionally, it impacted us from the standpoint is we started to scale our employee base. I'm sure if you guys hear a little echo, but we started to scale the employee base and be able to not train these people physically, right? Hand in hand, essentially, has been a challenge. At the same time, the ability to Zoom and GoToMeeting and things of this nature has really scaled our business as well, because FaceTime on our phones has really been a big thing over the last few years as well. So still being able to see that person and interact with that person, getting them up to speed on our processes, our server, how loans are boarded from a new seller onto our servicer, potentially how they're deboarded, things of that nature. I would say that has been a little bit of a mechanical challenge. But at the same time, this business for us has always been telecommunication at some point, right? A lot of the business that all of us here on this phone do is all the trading, a lot of buying and selling and modeling. And many of our people are contracted or not physically in our office with us. We've got about 6 people physically in our office. We got another about 6 people that we have contractors, and we manage national vendors. But all that is done just like this. So it hasn't, mechanically, from that standpoint, it hasn't bottlenecked the business too much. But I would say from being able to welcome a new body into our doors and show them things and be able to bring a culture is probably something we initially started to miss onboarding ourselves.
Very good. Yeah, one of our main challenges at Colonial was, we have about a dozen people that go into the office every day. And on March 25th, we were told, shelter in place was coming and we had to get everybody set up remotely. And it kind of took us back to the last Note Expo when we had a cybersecurity expert talk. And we realized, well, we got to make sure we're getting everybody working remotely. How are we protecting, our network and our server and all that? So we had to get all hands on deck and get everybody set up. And that's been our biggest challenge, is just getting folks all set up. And as soon as everybody got comfortable working from home for a month, and then all of a sudden Texas is going to start reopening. So now we're going back next week and we'll have a handful of people there. We'll phase in having folks go back to the office. So, and I know Paul had mentioned that he was doing one in his place, and I know that's a big adjustment for him. So, Paul, I always consider you the data guy. I know you're always digging into reports, and I know you shared some of that information in previous Note Expos and things like that. And I know you do a weekly update on your LinkedIn, which is awesome. So tell us, Paul, is anybody buying right now except for you? It sounded like you had a good trade you were getting ready to close. How is the market going?
Well, I think there's a lot of people trying to buy. and I think there's a lot of people trying to sell, but the gap between the bid and the ask is just too high. So if I start at the top, so if you look at the public REITs, the mortgage REITs, they've had a lot of forced selling. There can be 5 to 7 times levered. So every 1% of fall in value equals a 5 or 6% fall in their net asset value. And they have agreements with their lenders, which will mean that they have to liquidate their positions. And so that has forced some fairly big portfolios over the last 4 or 6 weeks. The biggest I saw was a $6 billion trade. This was $6 billion of performing paper that a well-known REIT was forced to sell by their banker, and that traded at 20 cents discount. So it traded for 80 cents on the dollar, which is an unthinkable transaction. And I was certainly horrified when I heard about it. There have been 1 or 2 other smaller transactions, but still in the several hundred million to $2 billion range, selling in the 80s, the low 80s. And again, that would be way, way below where they would have been selling 4 or 6 weeks prior. They would have been at about a 101, 102. So pretty shocking on the performing paper. On the non-performing, there tends to be less pressure on the sellers because they're not REITs that own them. They typically don't have a problem with margin calls, and so they can sit on that paper. So we were in a competitive situation. We bid some stuff last week, and our blended bid was about 62 cents of value. These loans were down maybe 6 months average. Their payments, they paid up until 6 months ago. And I don't know who got it, but the cover bid was 74 cents, which was still, I think, a pretty good deal. Not obviously the kind of price that we would want to pay, but we don't really buy that kind of paper. And then for the stuff that we typically buy, which is the kind of core NPL, where it would have been trading at maybe 60, it's probably trading now at 54 or 55. So it's come back about 10%. And then there's a lot of stuff that's just not trading at all, like second liens. There's been a lot of second liens that we've bid, and there's been no trade. So I think that some of the second lien sellers maybe still think it's February.
Right, good stuff. David, I know you do a lot of action on the SN trading desk, and you send out anywhere from 1 loan to 100 loans. What kind of traction are you seeing out there? Do you see the same kind of disconnect between bid and ask, or are folks on the lower level portfolios executing?
Yeah, I mean, it's in the last 3 weeks. I feel like I've seen it all. I'm on the exact same page as Paul with these performing RPL non-QM deals that typically trade a little above par. And we've probably put out 10 or 15 deals, and really only 3 of them have traded in that mid-80 level. And what happens is that, they get their mid-80s, which is what they wanted. And if you wait 2 or 3 days, they look at the stock market or something else and they realize, wait a minute, things look to be getting better. Maybe we should hold on. And so, on those big trades, it's timing. You got to tie them up right away. Otherwise, they will not get done. And you'll probably see them in another 2 or 3 months. That's what we're predicting. On the lower side, the NPL side, we've had many deals that were in due diligence during the whole virus time, and we've actually had a few clients come back during their due diligence and reprice the portfolios with this COVID-19 discount, which is very interesting. It was like going back to the days where, someone would give you a bid and saying, here's my bid based on a 10% BPO discount. Here's a 30% BPO discount. But now they're giving you a COVID-19 discount, which half of the clients that were selling actually accepted that discount and continued on. And what's happening is, though, I did send out an email to a lot of people asking, whether they were buying or not, because the smaller mid-size NPL deals, I'm getting no bids. Where 3 weeks ago, I was probably getting between 20 and 25 bids per asset, and I'm getting like maybe 1 to 2 bids, which is really no bids, which is very interesting. And just, I think the pricing is coming back with such a discount that I really advise the clients that are looking to sell and they don't have to sell is just to hold on to them. So clearly the trading desk is seeing a lot of changes, which is interesting. On the servicing side, we're seeing actually an increase of business, mostly because we're getting phone calls from, let's say, insurance companies that were originating loans and for the last 3 or 4 years have never had a default. Well, now they're getting around 4 to 5% of those loans are asking for this forbearance program, which they're not set up to do.
Right.
So they're asking us to come in and really do all the, kind of like a third-party vendor, doing all the paperwork and monitoring of these forbearances that these borrowers are asking for. So we've been really busy on that side. And a good, I can tell you that out of the 40,000 loans that we do service, we've had now up to today, we've had 1,600 borrowers ask for the forbearance. So it's out there, and it's just amazing how things have really changed so quickly in 3 weeks. Where we're used to this since we've been around '87, where this type of action took about 12 to 18 months to occur, not 3 weeks. So it's been interesting.
Well, that's good stuff. Good stuff, David. Cody,
well, I would just propose something real quickly, Bob. I think this could help a little bit of the audience here. Is that I wouldn't say an opposing view, but I would say that currently we just closed on 125 loan trade. We're not as big as an automation finance, so we are a $50 million book. So we're revolving around $25 million check writes every 6 months, meaning we're actively buying and then actively reselling some of that product. The stuff that we don't resell, we're seasoning up as a reperforming loan to eventually put back out into the market as a safe return for the end investor, backed by a single family home with a yield. Now, we feel strongly that some of the trades that we saw pre-pandemic, as we conducted our due diligence through the last 45 days, right, which has really been the uncertainty for us all, we have closed 2.5 points below our pre-pandemic level. So I don't agree with a COVID-19 discount. And I'm not saying David does either. But the reason why I don't believe in it is because we went ahead and ran 2 different valuations. We also spoke with local realtors who are currently selling properties. Yes, they're selling at a much lesser rate, especially as others have pointed out, the ability to go to an open house today has dramatically dropped pre-pandemic. But still people are buying houses, right? You can still acquire a deal. So all I'm saying to you is for us, we have 287 reperforming loans today. And what I mean by that is 18 months to 20 months of consistent payments have been coming in on those homeowners. And today we have 96% pull through as of April 30th. So that doesn't mean that our book of reperforming won't fall off here in May or June or July, especially as people continue to get furloughed and the ripple effect of payments drop off. But we feel like people should still be able to have a bit of character as we navigate through uncertainty. And if you feel like the value is still there, you feel like your exit strategy, if you were going to hold that asset, is going to be able to be strong as we navigate through the next 6 months. Or if you're even going to fix and flip, a starkly different example, and you still feel like the value of that home is still there, I don't feel like phase or value discounts should start being assessed to guys that are looking to sell, which is I'm a seller. Bob, you're a seller. Cody, you're putting a lot of trades out, and so are you, Paul. So I know some of us put our sell hat on, and some of us are always putting our buy hat on. But I just wanted to add a little bit of a contrasting view there.
Okay, good stuff. And we've seen in our book of business consistent payments in April as well. So March and April have been just as solid as we predicted. So we're waiting to see how May is, whether or not that's where the impact is going to come. I think because of our borrower profile, where we buy loans less than $150,000 and the payments aren't that large, with some of the government assistance, whether it's the stimulus check or the unemployment benefits being matched by the federal government, a lot of these borrowers hopefully should be able to maintain the payment profile. I want to go over to Cody and talk about something liquidity. You know, we had some trades going in the pipeline in February, beginning of March, and then some investors ran into some liquidity issues. How has that affected you and some of your trades, and how do you think that's coming as far as are people becoming more liquid? Or are we still a ways away from that?
Yeah, I think that you're not getting an echo from me, are you, Bob? Good.
No.
I think we did see some folks in a holding pattern where, if they had maybe a single investor and a sizable book, they were kind of going into more containment mode to say, okay, let's hunker down on the current portfolio as opposed to adding additional risk. And so I think that probably went at least 30 days, maybe a little bit beyond. And now we're starting to see folks say we're returning to a somewhat more predictable world, even though there's a lot of unknowns. I don't know that we can call anything more than as to what the future is right now, because there isn't really a playbook to reference here. So I think we're now finally entering a period where folks are starting to say, okay, we're going to maybe just move up the credit spectrum a little bit. Maybe you're tightening your criteria a bit in terms of it could be geography wise, it could be minimum fair market value wise. So you're applying more stringent filters on your acquisitions. But I do think that folks are getting back to normal now. And I think that just happened over the last week, really. I mean, there were some folks that were certainly bidding throughout. In fact, we've got 3 trades closing next week that are in the second lien space. So it's always interesting because even in a circle amongst us where we're pretty close knit, we can be seeing different things. We've got a 4th second lien trade that, in addition to the 3 closing next week, that we were just awarded yesterday. So we're actually seeing the second lien market. It could just be a function of your sphere of influence and who you're spending more time with, right? As to what you're seeing. I mean, we each there's the world and then there's our world, and there's only so many hours in the day and so much you can focus on. And so for us lately, it just happens to be we've got momentum with second lanes.
Yeah, I think Paul was just going for that COVID-19 discount on those sections, and that's why he didn't do them.
No, we thought we were actually the high bid on both the pools, but it was just way off where the seller was. On one, we bid, I think it was $5.3 million was our bid, and the seller said, "Well done, you're the high bid. Can you come up to $7 million?" Like a 28% increase in price. It's just like, how can you even say that with a straight face? But that's the price they needed, just under $7 million. So it was miles off. And the reason they needed us to come up was because there was another part of the trade and it had faded. It wasn't that we'd faded, that was the price. And I'm actually glad it didn't trade, because I think the price for that same portfolio next month will be lower than it was 2 weeks ago or a week and a half ago.
Yeah, I agree. How about inventory over the next 6-12 months, Paul? Do you think, I know you kind of touched on a little bit of it, not UM, what do you see coming down the pipe?
It seems to be very quiet right now. We sent a big title review order, and normally they say, it's going to take a while, and they said, "I'll have it for you on Tuesday." I was like, wow, it must be pretty quiet in the title world. And so it seems like there isn't a lot happening. I mean, new origination has fallen off a cliff because people aren't buying new houses, in that you can't go out and do an open house right now. They're down. I think I looked at the numbers yesterday. It was like 80% reduction from what it would normally be. So there's no new origination. And on the NPL stuff, it seems like the courts are backed up. It seems like there's a kind of a standoff between buyers and sellers. I can't remember who was it. Maybe it was Cody said, you know, sellers are thinking, well, maybe things are going to go back, or maybe it was you, David. Apologies if it was you. But I think you're right that sellers are going to go back. The sellers are saying, well, prices might come back. I don't see prices coming back, honestly. Maybe, you know, in December, but not next month. And so if you're a seller of NPL and you're not a forced seller, it's probably not a great time to be coming to market. So I think that would say might be a bit quiet on the sourcing front for the next few months.
Yeah, I think that's a good point. I think the people that are going to sell are going to be the ones that have to sell.
Right.
You know, whether they've got an underlying warehouse lender or credit facility they have to move product off of,
right,
or they close in fund, they can wind down, something like that.
Right.
If we're going to sell any loans, we're going to sell them at the pricing that we want to. We're not forced to sell. You know, but there will be some out there, I think, that will be pushed to sell, and there could be some opportunities for people like us to, you know, for lack of a better term, take advantage of their situation and find some product.
Right. Yeah.
You know, Bob, just to add to that comment on the seller finance side, I mean, we're generally talking about institutional paper thus far, but there's a lot of individuals that aren't, you know, kind of supported by, you know, a book of loans and an actual company. They may have one loan and they may be feeling a cash crunch out there. So I think that not to take advantage of any misfortune, but to actually provide a liquidity solution to some of those folks that say, hey, listen, the world has changed in the last however many months or years since they carried back a loan. That may be the biggest chunk of change that they've got. So I think that the seller finance market is likely to be fairly ripe over the next 12 months, where individual sellers may need to get a lump sum instead of payment streams.
Yeah, it's a good point. There's about 9 million single landlords who own a single unit. And so I would imagine a lot of renters are not paying their rent right now. And being a landlord, you can say maybe you like it and maybe you don't, but it can be a tough business. And only doing it with one home can be even tougher because you get no scalability. So it could be a lot of those guys, a lot of the Airbnb. You know, there's something like 500,000 Airbnb listings in the US. And a lot of those people are running a business as an Airbnb. Well, there's not too many people traveling right now. So I guess a lot of those Airbnbs are empty. And I think they may cause some distress in the market too. So there will be some pockets, I think, you know, sort of thematic type pockets where Vegas, Florida, you know, those kind of places that are heavily tourist dependent. I think they could be, you could see, you know, quite a wave there of ex-landlords or reluctant landlords who want to get out of the market.
One of the interesting things that we're trying to figure out and follow is with the banks. Are these loans that are going into this forbearance going to be classified as classified assets in the next 3 or 4 months? Because typically that's when the ratios and those type of assets, if they are going to be called classified assets, will be available for sale. Because that's typically when the banks want to move their classified assets to get the ratios back down. So I'm not sure if anyone knows if that will be called classified or not.
Yeah, I called Rudy Orman this morning actually with that very question, because I got a couple of questions yesterday about how the forbearance is working. So TDR's troubled debt restructuring is a specific term that every bank needs to report any loan that is troubled and is being restructured. And so the big question is, well, all of these forbearances that any borrower can get simply by calling their loan servicer and saying, hey, I'm in trouble, I need a loan restructuring. You don't need to prove any suffering. You can just say that, and they are giving you up to 3 months forbearance. So that means you don't make a payment in month 1 or month 2 or month 3, but in month 4, all 4 payments are due. Now, for lower income borrowers, the temptation to spend some of that money, or indeed if they don't have the money because they're not employed, if they're not employed in month 1 or 2, by the time they get to month 4, they simply won't have the money. So what happens? Does it get reported as a delinquent loan? And what Rudy was telling me was that all of the government paper, which is about 70% of the market, they're allowing, the servicer is allowed to make the call. They don't need to go back to Fannie, Freddie or Ginnie. They're allowed to make the call and tag those payments on the end. Now that is massive news, because that means that what would have been simply kicking the can down the road for 3 or 4 months is now actually a sustainable solution. So those 4 missed payments get put on the end of the loan. The big question, is what happens to the 25% of the market that's not government paper? Do those all get reported as troubled loans? And that's where the wave of foreclosure will begin.
Yeah, I think that was huge, because nobody would be able to make 4 payments in month 4 probably.
No.
But just to clarify, you kind of touched on it in a roundabout way, but the automatic forbearance plan really just deals with federally backed loans. It has to be a government sponsored loan. So a lot of us own portfolios that does not pertain to. And I know, and David can speak to this from the servicer standpoint, that a lot of people read the headlines, you think automatically they get a forbearance, but they don't, because they don't have a Fannie, Freddie, FHA, VA, Ginnie Mae type loan. So David, from a servicing standpoint, what are you guys seeing as far as people calling in saying, hey, I want a forbearance loan?
Yeah, I mean, as I said earlier, we're probably at 4% of our entire portfolio that's already called in and requested the forbearance. Now, you know, I don't follow the exact process of what each phone call goes through, but yeah, there's a huge portion of that where the person hasn't paid in probably 2 or 3 years, and so you know, there's some guidelines that we have to follow through. And again, it's really, at the end of the day, it's the investor or the client that we service for that's going to make that final decision, because they're not under, as you just all said, the 75% of the Fannie or Freddie or HUD guidelines.
Right. I mean, Bob, I think a lot of us can get caught up in a lot of the statistics, but many of the audience members here are folks that are going to be growing a 10 to 2 or 300 loan portfolio, right? And many of these are going to be privately backed assets versus government backed assets. And so with that being said, there's thousands and thousands of loans for the market to still acquire. But by the way, I don't know, David, you may have to go on mute. There's a little bit of echo on my side. But to not lose that point, I just want the market to understand that there's thousands of mortgages for each one of us to still acquire. And at the end of the day, if many of us are just trying to build a footprint in this market, there's so much opportunity that was well happening before this pre-pandemic. I mean, Paul can attest to, there were already billions of mortgages that were 9 and 12 months delinquent before February. And the billions of mortgages now that are going into default are only lengthening the runway that we all were buying into before all of this happened, right? And so I say that with the knowledge that, A, there's still a humongous market, and then B, what happens to all of the investors that recently we have shifted focus here at Revolve to, sure, we may not be an active seller, putting out as many mortgages as we normally do, but now we've shifted into capital raising, because we've seen so many investors lose their tail in the stock market, because many of us know they're a third lien holder, being a shareholder. And now that we've been able to show them the opportunity of being a first position lien holder. And by the way, there's no shade to the second, right? Because we believe that we're lockstep with one another in this market. So I wanted to make sure that the arena that we're all looking to still play in, the privately based market, because if you have the big banks, Wells, Citi, Chase, and others, and you look at the funds that are below those tier one funds that are buying from those massive banks, there are thousands of non-performing loans that these guys were still managing. So what happens, Paul, during these margin calls? What happens when these guys were holding a humongous book that was based upon performing mortgages, and then they went into default? So now they're going to have to liquidate that product because they're getting margin called to free up cash. So I just feel like the runway is just even further for everybody on this call and most of this audience that's watching.
Very good. I want to wrap up. I want for each of you to kind of either state something you've learned during this pandemic or a piece of advice to the note investors here as we start seeing some light at the end of the tunnel. Cody, what have you learned or a piece of advice for our audience?
Well, I think I've learned to appreciate some of the simpler things in life, and while we're focused on executing as a business, I think there's a part of me as a CEO with a team. It's a small team, but maybe operating from more of a heart-centered, compassionate position, and as woo as it may sound, thinking about a little bit more spirituality and appreciating the unknown instead of being fearful about it, and just knowing that that's sort of where the infinite possibilities arise is that mindset. So working on your mindset, that's a big thing for me and my family and my team. We just had our marketing call right before this call, and that's how I ended it, was just to be so excited about the opportunities that we've got. We're very grateful that we're in this industry, and the challenges that we face, I think a lot of people would love to have our problems. So I think it's just gratitude and appreciation. And the other thing is just, I say this almost probably every time we have a panel, is dig your well before you're thirsty, which means, it's Harvey Mackay, build your relationships. You're going to need them in times like these, and be of service to others, and it'll all come back to you. So relationships.
Very good. Thank you. How about you, Paul?
I think on the personal front, it's amazing and shocking in equal measure just how fragile life is. We had one of our team members get COVID. He was in the hospital. Fortunately, he's made a full recovery. But 35-year-old guy, 4 young kids, you just never know the day or the hour. So it's very easy to get overly focused on work, but I think it's something you need to think about, how that balances out with the rest of your life. On the work front, I think it's put a lot of pressure on our systems, and if our systems didn't work before this, they certainly weren't going to work when everybody is sitting in a different building. And so I'm probably the least tech enabled of our team, and it's really been pretty amazing how much you can get done. And I'm wondering, do I really need to spend $70,000 a year for this small office? I mean, maybe we could be a virtual company and all work from home. So we're reevaluating every penny that we spend, and I think that will be a good kind of reset mentality for us.
Yeah, I think before we get to Chaz, I think that's a great point, that no matter how long it takes to get out of this, the commercial office space industry is going to look completely different. Because more and more companies, whether it's a small operation like us or whether it's a corporation where hundreds of employees, when you find out most of them work remotely, you may just need a small footprint.
Yeah.
So I think there's going to be a big change there. Chaz, how about you? What have you learned, and some advice from for our folks?
I think personally, it was great for me because I love my work, so I don't view it as work. I view it as part of my passion. And so I was able to see my young 10-month-old take his first steps, and it was on a Tuesday at 11 in the morning, right? So I would have been at the office, right, talking to one of you guys. And so I'm thankful for that, because I would have had the wife calling me and telling me what I missed, right, or shooting me a quick video. So I'm thankful for that person's side. And I think what led that now to bleed into my business has allowed us to really use telecommunication really to allow us to still touch and feel every part of the country. I definitely feel that and it's funny, we're moving offices currently, right? So we're doing construction. The crews are full on masked up and bubble suited, and to see that the commercial space, like you guys were just mentioning, we've been thinking, look how much we're still getting done. I just mentioned we bought a trade just yesterday, and we're buying more pools currently next week. So it's like, look how much we're still getting done without physically having to see each other. So, but I would leave a piece of advice with folks is refine your strategy. I think for me, I've heard this a lot is we didn't come this far to come this far. And what that really means is I've been finding myself working more in the business versus working on the business. And this time at home has allowed me to work on the business and kind of look at the future and a little bit of the horizon after we get out of this level of uncertainty. And what I'm starting to see is I believe there's going to be a tremendous amount of opportunity and new money coming into this arena. And I think that there's going to be ways for a lot of us to raise capital. But what's our strategy? You as an operator, you as a sponsor, what are an investor buying into? What are they trusting? So I think that making sure you know what you're doing, because I think a lot of us don't know how to manage a portfolio from the comfort of your house and still get to these homeowners. These are still people. And if you're seeing cars in the driveway and you're not approaching these folks as humans, this business gets a bit tough and time consuming. But I think if you refine it and you're an operator and a sponsor with a clear mind, I think there's humongous opportunity by this deal. So
Awesome.
I'll leave you with that.
Also, guys, and I think David dropped off. We may have lost him, but
No, I'm here.
oh, there you are. There you are. Okay.
I just
So,
I took myself off of the video. I guess I was there twice. Personally, it took me 15 minutes sitting at my house in a so-called, what I called office, to realize I couldn't do it. I had to run out of there. Even though my office is only 2 minutes from my house, I just could not work efficiently at home for those 15 minutes. And I just realized, you know what? I've got to be in an office. I guess the one reason is because, of course, I've got 5 boys, and half of them are home finishing school or college or working. They're working for their companies out of home, and it just became like this echo chamber of people talking on the phone. It was horrible. So I guess I'm fortunate that I can go into an office where there's only about maybe 10 people in the whole entire building at any time anyway. So that worked out well. On the business side, I found it very interesting how quickly our systems group was able to take, we've got 185 employees, and we probably only have about 15 to 20 that are allowed in the office. So all of them are now remote, and how quickly we set that up. And we've actually brought in a team to analyze, as Paul was saying, analyze the productivity of them at home compared to them being in the office. So we're getting some pretty interesting results, which is pretty neat.
Awesome. That'll be a good conversation point at Node Expo, just how everybody adjusted to virtual being the new reality, and how that impacted it. Look, I figured, guys, if the NFL could pull off their draft virtually, surely we could have a conference call today and pull that off. So my advice to folks that are watching or listening is just to stay disciplined in your investment philosophy. Don't get crazy trying to chase a squirrel because you think there's a great deal out there and you're trying to do a bottom fishing kind of thing. Whatever your risk tolerance is, or let me say it this way, whatever your risk tolerance was, you should maintain that discipline, right? Don't just start going crazy. I mean, that's what I've tried to do throughout my career, stay disciplined to what our buy box is, so to speak. Look for opportunities. I think everybody on the call today said there's going to be some. Find the one that's going to meet your needs and your risk tolerance. So that's how I would do it. Gentlemen, I want to thank you guys for taking a Friday afternoon and spending a little bit of time. Paul, I wish we could do a little Irish toast and say goodbye. We'll have to do that next time.
We'll do it in Texas in November.
There you go. So we will hope to see everybody in person at Note Expo 2020, November 6th and 7th here in Dallas. So thanks again, guys. Everybody be safe. And I'm sure I'll be talking to you soon and we can do some trades together. So take care, everybody. I appreciate it.
Look forward
Take
to
care
it.
now.
Thanks for getting us together.